In the UK, the VAT treatment for used cars can differ significantly from new cars, primarily due to the marginal VAT scheme, also known as the VAT Margin Scheme. In this video, we'll take a detailed look at how the VAT Margin Scheme works and what it means for both car dealers and consumers. The first thing to note is that the VAT Margin Scheme is completely optional. So why might you want to adopt this scheme for selling your second-hand vehicles? The main benefit is being able to offer lower prices to your customers, especially if they're not VAT registered. Given that the VAT is only applied to the amount between the buying and selling price, the amount of VAT payable is significantly reduced for the customer. Another benefit is that it simplifies the VAT process for businesses by helping to avoid double taxation on the same goods. We'll show you an example of this later in the video. To qualify for the scheme, the goods must be second-hand and the seller must have acquired them under conditions where VAT was not reclaimable. Typically, any car which has been sold by an individual or business which is not VAT registered will have been sold without VAT and therefore falls under the conditions for marginal VAT. HMRC are very clear about the rules when invoicing for margin scheme sales. You must not include a VAT figure, and you must state that you are selling the items under the margin scheme, for example by stating margin scheme second-hand goods on the invoice, although the latter is something that many seem to ignore, particularly auction houses. MotorDesk's car sales invoicing and accounting software of course completely automates margin scheme invoicing for you. Dealers must keep detailed records of purchases and sales made under this scheme, including evidence of the margin made on each car. This is crucial for compliance and for calculating the VAT due, and HMRC expects you to maintain a stock book for your margin scheme cars. Again, something which MotorDesk's car sales invoicing software fully automates for you. Dealers cannot reclaim VAT on the purchase of a car that they intend to sell under the marginal scheme. This is because the VAT has either already been accounted for, or the car was purchased in a condition that did not include VAT, for example from a private individual. Dealers can also not deduct costs from the margin before making the VAT calculation. However, there is an exception, which is if the cost was part of the car purchase price and the car could not be purchased without paying that cost. There are a few examples of this, but the obvious one is an auction buyer's fee or admin fee. So long as that fee does not include VAT, it can be bundled into the purchase price. If it does have VAT, make sure you record it separately as it can't be bundled in, but you'll still reclaim that VAT, so it doesn't matter. It's also important to know that dealers cannot reclaim the VAT if you make a loss on the vehicle's margin. Hopefully this isn't something that will happen very often, but certainly a key point to remember when disposing of unsold stock. Now I'll show you a quick marginal VAT example. If you pay £10,000 for a used car, which you sell for £13,000, your margin is £3,000. Assuming you paid £1,000 to prepare the car for sale, your profit would be £2,000. But it's important to remember that the marginal VAT calculation applies to that £3,000 margin and cannot take into account any other costs incurred. The customer pays £13,000 and they cannot reclaim any VAT, as even if they're VAT registered, you won't have charged 20% VAT on the total. You must instead pay the VAT from the profit, which is calculated as 1/6 of the margin, which would be paid as part of your regular VAT bill. The total VAT to be paid is £500, rather than the £2,166.67 if 20% VAT had applied to the full £13,000 sale price. You will recall at the start of the video we mentioned that the VAT margin scheme is optional, so why might you not want to use it? The simple answer is if the customer buying the vehicle is VAT registered, they may want to reclaim the VAT, which isn't possible when the VAT margin scheme is used. In the previous example, we sold the vehicle for £13,000, the margin was £3,000, so the VAT payable was £500. Our after VAT value is £12,500, and critically, the customer could not reclaim the £500 VAT. If we add VAT to the £12,500 balance and charge the customer the full 20% VAT, they would pay £15,000 for the vehicle, £2,000 more than the previous example. As they're VAT registered, they can reclaim the £2,500 VAT, meaning they ultimately pay £500 less for the vehicle. We do realise that it can be overwhelming, and we hope that this guide was able to help you, although a DMS, like MotorDesk, will eliminate the need to worry about these requirements in the day-to-day running of your business. If you'd like to see the ways in which it does this, then head over to motordesk.com and sign up for a 30-day free trial.